Welcome, Fortune Builders community, to a new session of your continuing education with the Passive Income Club. My name is Pablo Gonzalez. With me, as always, the man that I affectionately like to call GC because he's got these genius concepts, knows how to generate cash flows, is a great co-host, and because his name is Gregg Cohen. Say hello, Greg.
Hello, everybody. Fantastic to be with you today.
And if this is your first time here with us, it's nice to meet you. And if you're coming back for more continuing education from us, good to see you again. I would love to see you check in here in the chat. Let me know who you are and where you're coming from, because we do this. What is it? Once a month, GC?
We do it once a month.
Why is it? Why are you teaching this Passive Income Club once a month thing?
Because this beautiful asset class can do so much for you as an investor, for your family, for your community, for your city, for our country. It is an asset class that I fell in love with about 20 years ago, and I've invested in since then. I've been able to really help people accomplish some incredible financial outcomes, but it's often misunderstood. So in conjunction with Fortune Builders and the Passive Income Club, we have the amazing honor and responsibility to be the educators here on a monthly basis to learn about specifically rental property investing. So if you came here for that, you're in the right room. Take a seat, and we can't wait to get started.
And the reason why they put you in front of this audience, GC, right? You guys have been essentially a partner of Fortune Builders since you were young bucks, you and your partner, Alex Safakis. Give us just a quick background of how you got here.
You know, sometimes you cross paths with individuals and it completely changes the trajectory of your career, your investments, and really your life. And that's what I had the honor and the blessing of doing. Meeting Than, Paul, Conrad, the Fortune Builders team before it was even Fortune Builders, when it was CT Homes and they were buying and selling hundreds of homes a year. And more than that, they had built this amazing company. And they took me under their wing along with my business partner, Alex. We became the very first Fortune Builders students. And that was almost 20 years ago. Since then, you know, obviously we have learned a tremendous amount from Than, Paul, and Conrad. Honestly, they learned a tremendous amount from us too, because we were their guinea pigs. Yeah. And it's grown into a business partnership. So like I mentioned, we're blessed, we're honored to be the rental property education training partner for Fortune Builders. And it is a incredible relationship spanning almost 20 years and thousands of mutual clients. And you know, how many businesses can say that they work in conjunction like that for that long? So many success stories. So that's why we're here today. I have sat in the shoes as many of our Fortune Builder students have, whether this is your very first, you know, class that you're taking. I remember what it feels like to feel like everybody is telling you that this can't possibly work. And, you know, a lot of people made fun of me early on when I invested in my education. I remember that feeling. I remember the feeling of doing my very first deal and that joy. And it wasn't about the money. It was about proving something to myself. And if that's you, I'm so glad you're here. If you are somebody who has achieved some success, maybe flipping homes, but maybe you're thinking, okay, flipping homes is great, but it's a lot of work. And I want to invest in my passive income as well. I want to start building my retirement account. This is a great training for you too, because that's what rental properties can be for you. You can continue to be successful flipping homes the Fortune Builders way. And in addition to that, you can build a rental property portfolio, which can take care of that passive income stream when you need it.
Yeah. And you see, you're not one to brag about yourself, but I think you also bears repeating that you've kind of earned your stripes to be this partner of Fortune Builders, to be this continuing education arm, to have this 20-year partnership by building JWB Real Estate Capital. JWB Real Estate Capital here in Jacksonville, it's a $200 million business. You guys have over $1 billion worth of assets under management. You have a team of 120 plus. You win all these awards. And right now, you guys are largely being credited with being city builders here in Jacksonville at this point, after, you know, beyond the 6,000 doors that you manage and the thousands of investors that you've helped invest here in the city of Jacksonville. So not only are you their first guinea pig student, you're also notably one of the most successful ones. So that's why we're here. That's why we get to teach this every single month. And just so you know that you're in the right place, we are talking about finding the best markets to invest in rental properties in 2025. To be very clear, not financial advisors. Do your own diligence when it comes to these kinds of things. This is for informational purposes only. It just comes with a ton of experience and thousands of data points of having helped people. Anything you want to add to there, GC?
No, I think you nailed it. Let's jump in.
Well, before we get into it, you talked about it passionately, right? Like we'll get into how to find the best rental market, but I think a lot of folks in the Fortune Builders community, they're in a couple of different asset classes, not just they're for real estate, right? Like you have invested in 400, you own 400 rental properties. You have served thousands of clients in owning single family home rental properties. What about single family rental home properties? Is it that is so special of needing to look for a market in order to invest in them?
There's a couple of things, but the first thing is I like to work with the end in mind. I like to work backwards. And I started with the end in mind. This was 20 years ago when I met Than and Paul, and when I had educated myself and read books like Rich Dad, Poor Dad. What jumped out to me is that I could build my financial outcome based on this asset class. And that was really key. Because when you think of an asset class that you want to build a financial outcome on, meaning like retirement or sending your kid to college or your grandchild or leaving a legacy or becoming very charitable or living a lifestyle that you can go and travel around the world, whatever that outcome is for you, that asset that is underlying that outcome must be consistent. It must be predictable. And we want it to have a higher return on investment than other alternatives. And when you find an asset like that, that's something that you can build your retirement account on, your financial outcome. So I started 20 years ago and I just felt like I had an aha moment where it was like, this is the right asset for me. I fell in love with it. And I also was like 20 something at that time. I was like 22 at that time. What also appealed to me is that I didn't have any money. I didn't have any real estate experience. What had low barrier to entry? And single family rental properties have very low barriers to entry when you start to look for assets that are consistent, predictable, and have high returns on investment. So that's really why I fell in love with the asset. The other thing about it, I'm investing in a critical need. And this is really important because if I want predictability, if I want reliability, if I want it to be there when I need it, it needs to be an asset that is based on some type of critical need. Housing, as we know, is a critical need. It's a critical need for an individual. It's a critical need for the family, for the neighborhood, for the city, and for the government. That's why our government actually incentivizes us with such amazing debt options, amazing loans that we can get. You go to another country out there, you're not getting 30-year fixed loans. So investing in a critical need is important. And it's kind of like, I want to ride that wave where everybody needs this to win. I want to own assets that are a part of that strategy. And then it shows up in things like the stat that I have pulled here for you. You know, I've come from the Jacksonville, Florida market, so that's where the lens will be for today's training. But in Jacksonville, and this is very similar to the rest of the country, if you go back from 1982 to 2024, 88% of years, home prices have gone up. Predictability, reliability, consistency. There's only 5 years that home prices have actually gone down since then. Those were the Great Recession years. So another way of saying it is that home prices have gone up every other year outside of the Great Recession, which was an anomaly in itself. So I want that type of asset that is based in a critical need because it gives me these things like consistency, predictability, and a higher return on investment.
Yeah, it makes a lot of sense. You see, we've seen this idea of the safety of a critical need in these recent moments that we've had of turmoil, right? During COVID, during these types of black swan events that happen when things get disrupted. You know, we never thought that offices would all of a sudden be like something that people are debating whether or not to use or not.
Right.
We've seen, you know, like big multifamily come in and out and luxury homes come in and out and during different times. Short-term rentals be cool and then be less cool. The idea of workforce housing, the houses where American families want to live in when they work, these jobs that are somewhere between like within 20% of the median income, like nurses and firefighters and Amazon logistics centers and people in the military. Those types of things are always, are always sought after and are an absolute critical part of the infrastructure of our society. So there is just this like major high floor that comes with this asset class.
Yes.
Right. So we are talking about single family homes today. Carla, I know that you were hoping to learn about multifamily properties, 30 plus units. I hope that you stick around and you learn something new about single family homes today.
And Carla, I'm here to be a resource for you. So if you have specific questions about that, I certainly can speak on that. I would encourage Carla and everybody who has specific questions, put them in the Q&A, and we're going to save some time at the end to be able to answer those questions for you.
Yeah, cool. So that being said, when we are talking about single family homes, it is really, really important to understand that single family homes pay you 5 different ways. And if you don't understand the 5 different ways that they return for you, people tend to make mistakes and overvalue one of these profit centers. Those 5 profit centers are net rental income, right? Exactly how much your monthly income, aka rent, exceeds your monthly expenses. We want that to be positive. There is tax savings, the amount of taxes that you save on that income, that you get to keep more of what you get. That's part of the return. There's principal pay down, the idea that when you have a renter living in one of these homes, they are paying down a loan that you took out, and over time, that the balance of that loan goes to your bottom line. And home price appreciation, the idea that home prices rise in value, right? That's pretty simple for us to understand. And most importantly, to understand that one is the idea that home price appreciation during small periods is much less predictable, but during long periods, when you're thinking about a full market cycle, which is 10 to 20 years, you can clock it. Like you can look at 30 years of data of a market, and you will know what that home price appreciation of that market will be, as long as your horizon is a long-term horizon. And then there's inflation hedging, inflation profiting, something that's become much more topical these days. As prices of goods go up around you, the price of your home retains its value, because replacing a window is going to cost commensurate to how much prices have gone up, whether it's with tariffs or inflation or whatever is happening. That holds value, unlike other things that aren't necessarily tied to everyday pricing. So it keeps up with that type of stuff. How did I do that, Juicy?
You did wonderful.
Yeah.
We started doing this show 5 years ago, and a lot of that was me teaching on those 5 profit centers. The reality, guys, is those 5 profit centers are so important. What Pablo did is a brief understanding of it. There's a lot more there. So if you need more information on that, this training's not specifically going to go into that. We'll share some ways for you to get in contact with us and with the Passive Income Club to be able to give you additional trainings, or if you'd like to talk to us about it. But those 5 profit centers, I love them. I love them because there's the upside component. I think when we think profit centers, we think of profit and upside, but I love them because of the risk mitigation as well. Most assets, when you invest in, only pay you one way. The idea is you buy low and you sell high. Well, what happens if you buy high and it doesn't go higher, right? Or it goes lower, right?
Or you buy low, you got it high, but then the moment that you actually want to exit, there's a dip in it.
There's a dip, right?
Yeah.
The beauty of single family rental properties are that it pays you 5 ways. And if one of them is not exactly firing this year, guess what? There's 4 other ones that are working in your favor. And we're seeing a lot of that. So that's why the rich, the savvy, they want to own hard assets. And that's why. It's because it's risk mitigation built in, as well as profit potential. And I wanted to do one more thing here, because a lot of times I get asked the question, why do you own so many single family rental properties? Why don't you jump to apartments? Why don't you jump to commercial? Why don't you do that? And I feel like I'm the weirdo in the room, right? Because I love single family rental properties. I don't look at them as a stepping stone investment. And I think many people think of bigger is better, or more beautiful, or a 100-door apartment complex. But there's cons to that too. Single family rental properties are this beautiful combination of allowing you to have low barriers to entry, like I mentioned, specifically lower cost to enter. If you invest in things like multifamily properties or commercial, those can be great investments, but expect to start to put in hundreds of thousands of dollars to be able to invest. You don't have to do that with single family rental properties. Not everybody can invest in a commercial asset or a multifamily property because you might not make enough money. It's called being an accredited investor. Well, in single family rental properties, there's no amount of money you have to make. Anybody, a non-accredited investor or an accredited investor, can invest. So those are 2 reasons, but there's 2 other ones that I think are even more important. It comes down to control and flexibility. And when you start to invest in other asset classes, many times it's in a fund structure or a syndication, a fund or a syndication can be a great way to invest, but just understand that you lose control. You lose some element of control and flexibility. When you put your money in with a lot of other money and it's based on a certain business plan to produce, sometimes that business plan doesn't work. And you can't exactly go to the fund operator and say, hey, you told me I was going to get my money back in 2 years. It's been year 5. I need it back.
Yep.
You know, it is a loss of control. So control, flexibility. If you want to refinance, you can do that. You can go to the bank to refinance a single family rental property. You know, you can't do that, and because most of the time the fund structure is or a syndication is the structure for some of these other asset classes. So, guys, I would love for more people to just say, you know what? The thing that is going to drive my financial outcome is the thing that I'm looking outside my window right now. It's in my street. It's in my neighborhood. It's like right underneath my nose. That's how I feel about single family rental property. It's a very deliberate choice. And the clients that we work with see that as well. Although, you know what? We might be a little bit different than everybody else who tends to think of it as a stepping stone.
Which is why we call our podcast the Not Your Average Investor.
That is true.
Right? It's not the average take on investing. High floor coming from a critical need and coming from these 5 profit centers. High upside based on the fact that it is always undersupplied and has excess demand when it comes to workforce housing. And control, right? This idea that when you own the single family property, you control your outcome and you have all these other options to choose from. But these folks came here to learn one thing, GC. How do we choose the right rental property for investing?
Well,
the right market for investing in rental properties.
There we go. Again, you'll see a common theme, and I learned this through Fortune Builders. Let's start with the end in mind.
Yeah.
Right? So now I understand that this is the right asset for me because I started with the end in mind. It's an asset that's going to be there when I need it. It's consistent, reliable, and better returns on investment. Well, now if I'm going to choose the right market, let me start with the end in mind. And the end is, how am I going to make the most money? We know that we have 5 profit centers in rental property investing, but those 5 profit centers are not created equal. And what you will find, and what we'll lovingly share here, is called the Pac-Man principle. This is something that Pablo and I kind of came up with. And really what it means is that if you look at how actual wealth is created in single-family rental properties, and you do it in a pie chart, what you will see is that you'll start to see a Pac-Man form. And you see the bigger part of the Pac-Man, or the Pac-Man that's chomping down, is the bigger profit center that drives the most wealth out of the 5. And guess what, guys? It's not cash flow. It's not tax savings. It's not even principal pay down or inflation hedging. It's home price appreciation. Home price appreciation accounts for between 60 to 80% of your total returns. So if you want to grow a bigger pie of wealth, we need to understand that home price appreciation is going to drive that. And then we need to account for that in the market that we choose. Does that make sense?
Yeah, it makes sense. And I'm just showing on the screen here a bunch of different Pac-Mans, right? Like this idea that on our podcast, we talk to rental property investors over and over again. We do this distribution of returns. We lay them out on a pie graph, and we continue to see the fact that the majority of returns come from home price appreciation. So it looks like a Pac-Man with everything else being the mouth. Sometimes it's a little bit further open. Sometimes it's more closed, but the Pac-Man continues to chomp it up, right? And lead to growth. And the reason why this is so important is because the majority of conversation around rental properties start and end with cash flow. They start and end with cash on cash return, right? When what we have seen over and over, based on the thousands of folks that you guys have helped invest in this asset class, is that the thing that really moves the needle for you, the thing that will change your life the most, is home price appreciation and putting yourself in a position where you gain the most from home price appreciation while mitigating for the downsides and maximizing the rest of the profit centers as well.
It's football season. How do you like to relate cash flow and to the football? I think the analogy is great.
I haven't said this in so long. Did you see?
I'm gonna dust it off.
I am a football nerd. I'm a quarterback nerd, right? As somebody who grew up a fan of Dan Marino, and then I've never had a quarterback again. So I watch the draft every year, looking to see who can be the next great quarterback. And I always hear people breaking down arm strength for quarterbacks, right? I've seen over the years quarterbacks get taken because they can throw a foot, they can take a knee at the 50-yard line and throw it through the uprights, right? But when you look at what's on the field, when you look at who wins in the NFL, they are extremely accurate, good decision-making quarterbacks that have a certain level of arm strength, but it doesn't really matter if they can throw it through a garage door, right? Like you just got to be able to throw the 15-yard out and get it there on time. Beyond that, it's just like fancy, right? So I think cash flow for people is like arm strength for quarterbacks. You got to have positive cash flow month in, month out in order to make the experience really good and in order to get you there. But everything else is just kind of like beach muscles for it. And what really matters is this idea of making the smart decision of being in a market that has good home price appreciation, using leverage, allowing the 5 profit centers to build while cash flow continues to grow, because cash flow grows over time.
Well said. Well said. Here's the reality. Many people only make their decisions on cash flow, but cash flow today in your investment is not going to change your life. $100 a month or $200 a month from a rental property is great, and it should be celebrated, but it is not going to change your life. What will change your life in rental property investing is a market that is going to grow more, that is going to appreciate more and allow you to scale up. Now, in order to do that, scale up meaning add more properties over time. In order to do that, we need to make sure that they're cash flow positive, right? We can't forget about being cash flow positive. But if we want to change our financial future, it is not going to come from cash flow.
Yeah.
You're just not going to buy 100 or 200 or 300 properties. It's just highly unlikely. What's more likely is you buy 3, 5, maybe 10 properties in the right market. They produce positive cash flow. They're paying for themselves. And then you get that 60 to 80% of your portfolio coming from much more growth from that market than you otherwise would have received if you stayed in a market that only had cash flow and did not have population growth and did not have a lot of home price appreciation.
Yeah. And you see, when you say this, I think it bears comparing to other cash flow markets. But I think Ariel Drake has a really good question that would allow us to frame the entire criteria, right? Right now, what we're saying is don't overcorrect only for cash flow, but there are other things that you want to see in a rental market that you're going to invest in. So Ariel's question is, I was initially sold on benefits of investing in Florida, especially West Florida markets like Cape Coral, Tampa Bay, and North Port, because they seemed unbeatable. Low hurricane risk, no state income tax, newer homes with fewer repairs, and better quality tenants. But the reality has been different. We've seen higher tenant turnover than in our California portfolio, more repairs, especially AC issues, higher property taxes and insurance costs, and stagnant rents due to oversupply. What did I miss when I decided to move my capital to Florida? Where can I get the biggest bang for my buck?
Ariel, fantastic question. Thank you so much for being here, and what a thoughtful question. I think what this highlights is the order of operations. And what most people do when they go and they buy a rental property is they focus on the property first. They spend all of their time analyzing the property. Many people don't take the next step because they don't look beyond their backyard. But if they do, they may take a step and start to think about the market. Ariel, it seems like you considered the market when you were investing. So kudos to you. However, that's really not the place to start, right? The place to start is the team, because to win in rental properties, you need to make sure that you're here for a full market cycle. That's how all 5 of these profit centers work. And if you don't have a great team, a management team, an asset manager and a property manager managing the money for you, well, you're not going to last long enough to see all the benefits from those 5 profit centers. So most investors go property, maybe market, usually don't put any due diligence into the team. They just go with anybody that they find on Google or ChatGPT as far as a property manager. Our clients flip it on their head. And our clients spend a lot of their due diligence on the team. Is this team worthy of being a steward of your money? Do they understand how to drive a return on investment? Do you interview them? Do you like working with them? Like, that's where you spend the time. And as I think about your question, Ariel, when you have seen higher tenant turnover, more repairs, some of these other things that you're bringing up, that goes back to the team. So that doesn't necessarily mean you missed the market completely. It means, did you find a team that is vertically integrated, where all aspects are under one roof? Is your property manager the same person who sold you the house in essence? That's critical. Do they sign long-term leases? Do they have an average duration of residence stay of 4.5 years? These are some of the questions that you need to spend time doing when anyone is buying their first rental property. And if we do those things, the chances of you having higher tenant turnover, more repairs, some of these other painful things that you've experienced goes down dramatically. So team first, do your due diligence on the team. Once you find a team that's worthy of managing your money.
Greg, I would like to add a couple of things that you just said. You mentioned a whole bunch of statistics
Yeah.
and a whole bunch of numbers that I think that is very easy to put in front of a investor, right? So like you mentioned two different things. One is, hey, what's your feel for this team, and are you getting good vibes, and do you like working with them, and do you think like they've been around? But I think there's a deeper thing as well when it comes to teams and it comes to markets of how long that team has been operating in a market, and are the numbers that they are promising you proprietary numbers? Are they ChatGPT numbers, or are they bot numbers? And you'll know that a team can deliver what they are promising, partially because of what you just talked about. Like, you get a good feeling of how professional they are. But I don't think there's anything better than past performance, right? So like if you're telling me, hey, this is what your rental experience, this is like what an average stay is going to be for a renter in your property, and this is how quickly you're going to be able to replace it, and this is what turnovers cost, and these kinds of things. My first question is, what are these numbers based on? Are they based on past performance that you have showed that you can show me, or are these based on did you ChatGPT it, or did you buy this data from somewhere else as well?
It's a dirty little secret, especially in the property management world and in the real estate investment world, specifically in single family, that people just don't know their numbers, and they hide behind industry standards or numbers that they Google or ChatGPT. I think it's a really critical point before you're thinking about investing with somebody and you're understanding if they are worthy of managing your money for you in this asset class. Ask them, what is the source of their numbers? For somebody who you are trying to replicate success with, that means they should have done it before. That means they should have data to support their thesis, and it needs to be solidified. Most people don't ask that question, and when property management companies get asked that question, most of them don't have a good answer. So I would highly recommend asking that question: the source of your data. What shows me that you're going to make more money with me along the way? Like, what data shows me that we're in this together, that our goals are aligned? Those are some really good questions.
And Eleanor Balash is asking, when you say team, you mean property manager? Yes, we mean property manager, but there's different structures of how a property manager is happening. It could be a third-party single home property manager. It could be, or it can be like a vertically integrated provider that is the same source that procures the home, remodels the home to a certain standard before they give it to you, and then manages the property, right? Like that piece of it, the idea that there's only one finger to point is really important, specifically when Ariel is saying, I have a good team. The issue is location, right? Oversaturated, repairs are weather related, AC and rods, hurricanes, properties for rent today are 3x what they were 3 years ago, which he's right. There is an element to the market piece, but there's also a question in my mind of like, is it really a repair that is weather related, or was it just not brought up to snuff before he bought the property, right? Like that is what you eliminate when you work with somebody that's vertically integrated as well.
And I don't know your team specifically, but what I can tell you is that your team should set expectations with you as far as what your repairs should be, and there should be really good data. And if they are weather related, then that should have been built into your pro forma right off the bat. Right. We're in Jacksonville, Florida, and we are in Florida as well. And, of course, we have storms and things of that nature and whatnot. But we know, because of the 20 years of experience, on average, that our maintenance cost is going to be about 7.5% of rents for an existing home, and it's going to be about 4% of rents for a new construction home. And we know what our vacancy cost is going to be. We know what our property taxes are going to be. We know what our rent growth is likely to be. So somewhere along the way that should be explained to you. Now, hopefully that was, but then that starts to mitigate the risk of like, well, it's weather related or whatnot, because weather happens everywhere. But if going in based on weather patterns that have happened over the last 20 years, and they have data to show you that on average, it's going to be 4% or 7.5% for maintenance costs, then you can manage those expectations appropriately. Other things to consider, you mentioned some markets there that are not, there are some glaring weaknesses, right? Cape Coral doesn't have 1 million people living in that market.
Yeah.
So when you're talking about oversaturation of homes, the supply and the demand is something that you can largely look at before you get into an investment and say, is that where I want to stake my financial future? Choosing a market with over 1 million people living in it is an easy way to say, you know what, that's a major market, or that's a big enough market for me where the risk of oversaturation is less, or the risk of one employer leaving is less. And when you get into markets that have, hundreds of thousands of people living there, oversaturation can happen much easier, and job changes can be a little bit different. So we have some really great additional trainings, Ariel. I love your questions. Keep them coming. And if you would like some additional links to other trainings that we've done, just reach out to the team. We'll have it on the slide here soon. Reach out to the team, and we'd be happy to provide any other trainings on the market or on the team to be able to help you. But if everybody can kind of rally around team, market, and then property, that formula works.
Yeah, and I would just say, just to preview that, right? Like, I think when we talk about a market for rental properties, we are talking about a market, like you said, that has over a million residents, right? Because then it is an established market. It has less of these swings based on small things that happen. It has a well-diversified industry mix. Right, like there's markets that are heavily based on tourism. There's markets that are heavily based on different kind of like things as construction. Right, like these smaller Florida towns are heavily construction based markets. Right, so like they go up and down based on these kinds of whims. So having multiple Fortune 500 headquarters is something that you want to be looking at. You want to be looking at historical growth rate of the market and what it's doing. Is it on the right side of like trends and things like that? And the last thing that I'm just going to say about that part is Florida, there is no Florida real estate market.
Right.
The Miami market is very different than Cape Coral. It's very different than Jacksonville. So I would encourage you to think beyond state parameters, because real estate is a highly localized game, and it's all about MSAs. What's the MSA stand for?
Metropolitan Statistical Area.
Metropolitan Statistical Area, right? So if you understand the job dynamics, the growth dynamics of the city, like why people are moving there, and then all the real estate numbers as well, you get to start having a much better look at this thing, right? So the idea of like over 1 million is just kind of this threshold that Gregg and I believe in, because it mitigates risk of the small fluctuation piece. The well diversified job mix is something that is really important to look at, and then the growth metrics and where they are coming from and how they are happening, right? This is why the Sunbelt cities are doing well. People are moving there, right? Like in Cape Coral, for example, has growth rate of people that are retiring, but it doesn't necessarily have like industry of like jobs that people are moving there, right? So it's a much more kind of like fluctuatingly, like it's more prone to fluctuations than a more well-established city inside of Florida.
100%. And where we learned this approach? We learned it through Fortune Builders, right? The passive income club for a long time has given those parameters of what defines a good city to invest in. Obviously, there's positive cash flow, but over 1 million people living in that city is one of the criteria as well. So we know it works, and those cities that work because they're risk mitigated with upside. Risk mitigated first with upside.
Yeah, correct. All right, cool. So do you want to continue with the presentation, or do you want to keep answering questions?
Whatever you want to do. Whatever the people want to do.
Yeah, I think there's really good questions really good questions being asked. So Anna Huff is asking, do you think you can live wherever you want and invest anywhere, or do you think it's necessary to live or stay near your investments for a time? Like what's that look like?
I've seen over 1,700 clients live wherever they want. We've generated over $317 million in profits. I see billions of dollars of real estate every quarter when I analyze the numbers and we send our reports out to our investors. I see this, and a relatively low number of people live within a stone's throw of Jacksonville. So, answer to your question, it has been proven that now, because there are companies that are vertically integrated and there's technology to do this, and there are bright minds in this space, you can do this concept of turnkey rental property investing from anywhere in the country. We have clients from 49 states and 13 countries, and they all choose to put their money in Jacksonville. And so this is possible. It just wasn't possible 20 years ago.
Yeah.
There was no turnkey rental property investing. This is new and different. So yes, I'm a testament to this. There's many people in the chat here who are investing passively in turnkey rental properties. You can absolutely do it.
Yeah, and to answer it more specifically, man, I was living in Miami for a long time in my life and thinking that way, thinking I need to be within a drive of the property that I was going to invest in. And that basically ruled me out of rental property investing. In Miami specifically, because it was so overpriced and it felt like sitting at like the table in the Bellagio where like the minimum bet is $500 and I'm here with like $500 to spend for the weekend, right?
Right.
So, there are certain market dynamics that will not exist in your backyard that make it attractive to invest. For example, you live in one of these small towns where there's high fluctuations, or you live in an overpriced town, right? Like the idea of price to rent ratio is something that you really, really want to be looking at because that guarantees your cash flow over time, right? Like being able to buy something with debt and still have positive cash flow is really important because, like we say, cash flow is the entrance to the dance. You want to have positive cash flow as you're investing, but you also don't want to give up this idea of being in a super, super small market that it could greatly fluctuate in one company announcement could greatly change the value of your property and turn it into a ghost town as well, right? So this idea of finding positive cash flow, finding home price appreciation in your market, it being over 1 million inhabitants, it having a good mix of Fortune 500 companies and industry, and then industry mix that has multiple sectors that are major employers there, are all things you want to be looking at way before thinking of, can I get there in an emergency? That's why we talk so much about really believing in your team so that you're able to get that done.
Well said.
What else? So exciting. So you always at least visit the property with, so do you always at least visit the property to see it with your own eyes before you purchase?
I'll answer that question with a question. When you invest in the stock market, do you always go and visit that company? When you invest in a bond and you lend money to a city or a municipality or a company, do you go and visit that company? No. This can be a similar thing. Now, the great thing is that you can go and visit the company, and we love to have people here. We have lunch offered every single day, and we always invite everybody here. And we have ways to get together. We do an annual user conference, a client conference, once a year. So we love meeting our people, but you don't have to. And the great thing is that if you choose to, it's a tax write-off. So you don't have to. There are many clients that never see their homes. And that's a great option. If you want to come and enjoy and get to know us and shake our hands, that's awesome. We want that. So I hope that answers your question.
Yeah, and I wanted to also answer, Ariel brought up insurance a couple of different times, and insurance in Florida specifically. Do you want to tell people about like the misconceptions about insurance in Florida?
Yes. Many have read the headlines or seen the news stories, especially over the past couple of years, about Florida insurance. And there is a very big difference between what was happening 2 years ago versus what is happening here and now. And it relates a lot to you as a rental property investor. To bring everybody up to speed, 2 to 4 years ago, there were legal loopholes that allowed lawyers to sue insurance companies at a very high rate. In the state of Florida, we had 9% of all claims, but 79% of all the lawsuits related to claims in one state. And that was, compared to the entire country. 79% of all the lawsuits related to claims in the entire country came from the state of Florida. So there was a big imbalance. And the state legislature stepped in a couple of years ago, and they closed those loopholes that made it easy for lawyers to sue those insurance companies. What was happening prior to that is it got so bad that insurance companies were no longer profitable, and they decided to leave. And that created a pinch for rental property investors, for homeowners in the state of Florida. That was then. That is not now. Florida is, we have more and more insurance companies coming into the state every single quarter. We actually just did a training with our insurance teammate who shared some incredible stats about the number of insurance companies that are coming in. And I was like, how often is it that you have, I think it was 10 or 12 or 15 insurance companies coming into the state? I was like, does that happen routinely every quarter? She's like, No, that never happens. So we have more insurance companies now back in the state of Florida. Insurance companies are making money again in Florida, which is, it's been weird to root for an insurance company making money, but that's what we want because we need more competition. What has happened here is there is insurance price stabilization in Florida right now. Your premiums are stable, and the problems that led to that spike in costs are now in the rearview window. In fact, the state of Florida has had the the smallest percentage increase out of all states from last year to this year. So it is a story of stabilization now. And that's what people who understand about insurance in Florida will tell you. The news cycle is trying to catch up to that. But what this means for you as a rental property investor is, yeah, insurance costs are higher today than what they were a number of years ago. That's real. But your rents have also gone up dramatically, and you still can get positive cash flow when it comes to rental properties in the right market in the state of Florida. And I'll just share with you a specific example. For a new construction home, the average insurance premium is $700 a year. $700 a year for a brand new construction home in the Jacksonville market. So that just shows you how how affordable insurance is in Jacksonville specifically and in other places in Florida, and how you get positive cash flow.
Got it. Rochelle Logan is asking, what are some tools we use to predict/measure future home price appreciation, single family home appreciation by market? Because she uses 4.6% in her projections.
That's a really good projection. It's all about the source of the data, and you need to go back over a long period of time. So the right way to measure home price appreciation is to look back as far as you can over your market. Make sure you have a single source of truth. So if you're comparing it across markets, it's not, you're not going to different places to get it. So for us, we pay about $30,000 a year to a consulting firm to be able to get this data. And it informs us to be able to make great decisions for ourselves and for our clients. And so we go back from 1982 all the way to 2024. It's the last data that we have. And over 40 years, we look at what is the average appreciation rate for each market. And what you see is there are some markets that win, that have higher than normal home price appreciation, and there are some markets that don't. And the markets, generally speaking, that have higher population growth and have a reason for people to be moving there, that is state income tax, no state income taxes, great business environment, great quality of life, great weather, some of those things. Those places like Florida, like Jacksonville, are seeing higher growth. So long story short, you got to have a great source of data. You got to go back as far as you can, go back 40 years if you have the data, and then run the average annualized home price appreciation for your market. 4.6% happens to be the average annualized appreciation rate over the entire country over the last 40 years. So that's sort of like the middle, right?
Yeah.
A growth market would be one that has higher than that. A no growth or a slow growth market would be one that has lower than 4.6.
Yeah, and just right on time, I'm showing this slide over here that shows, we are, like we said, in the criteria of a market that you're looking for, you want a cash flow market, right? Like you want a market that has positive cash flow. Some of the highest home price appreciations are in markets that you can no longer get positive cash flow when using a conventional 30%, 25% down loan, right? You can get positive cash flow if you invest in cash, maybe. Obviously, if you're buying it all cash, right? But the markets that are out there that are cash flow markets that people typically talk about are markets like Cleveland, Memphis, Indianapolis, Kansas City. And if you see here in this chart, their home price appreciation is 3.5, 3.8, 3.9, 4.8%, which doesn't seem like that big of a difference between 4.8% and, let's say, I don't know, 3.8%. Well, it's 1% difference. But when you look at the percentage of difference, right, like 1% difference is actually a 26% actual total difference in what is the biggest bucket of your wealth creation engine. So you really want to consider these types of fluctuations, right? Like looking at it localized, right? Not at a national level, which is 4.6, not at a state level, but look at your investment based on that local market and getting that data.
Mm-hmm. That's what you do. So,
yep. Sorry, go ahead.
Oh, well, I was going to say, the formula here is cash flow and growth. Yep. Cash flow and above average growth. You get cash flow by having low prices and high rents. So whatever the best data that you can come up with, look for prices that are below the national average. Look for rents that are at least in line with the national average or hopefully more. That'll help you kind of figure out where your cash flow markets are. That's important. If you can find a positive cash flow market, that's a good start, but don't stop there. That's where most investors stop. And what happens is they end up leaving a lot of money on the table, and because they choose markets that do not have this above average growth. So low prices, high rents, that gives you your cash flow. That's a start. Then use that small number of cities and go find the one that has more than 4.6% home price appreciation. Obviously, you know I'm biased and I love Jacksonville. That's where all of my investments are. But this is the reason why we advocate for the Jacksonville market, is because it has low prices, it has high rents, and it has an average of 4.8% home price appreciation across the last 40 plus years. And you don't see that in cash flow markets.
Yeah. Also has 1.6 million residents. It has something like 4 or 5 Fortune 500 headquarters in here. Has a mix of the industries is a mix of government, logistics, finance, healthcare. There's one more in there, right? Fintech.
Yeah, fintech.
And fintech, which actually hits as a different one, right? So that is why we're so bullish on it. We have this report about the Jacksonville market for anybody that is interested in. You can get it at jwbrealestatecapital.com/FB. That's right. It's actually a printable little magazine thing, right? Yeah, it's a real report, y'all, of what's coming out in Q4 2025. And we say that because we want to talk about what grade markets do you invest in Jacksonville? What grade markets in Jacksonville? Okay, yeah.
You want me to roll?
Well, yeah. I'll let GC answer this, but we're gonna talk a little bit about specific opportunities that we see in real estate right now in single family homes of that are good to be taking advantage of. So I'll let you answer that, and then I just wanted to
a little bit. So common investor way of kind of analyzing markets is A, B, C, and D. Right? In neighborhoods, right? A, B, C, and D. A is your nicest neighborhoods, and D would be your least nice neighborhoods. You want to invest in workforce housing. That is the risk mitigated place where you also get significant upside. And so our strategy is based on investing in workforce housing. The A, B, C, D thing is subjective. It really is. You generally know an A and you generally know a D. B's and C's, it's beauty in the eye of the beholder there. So you want to be in your version of a B or a C. And so that's where JWB invests. That's where all of our clients invest. We want to be middle income and slightly below middle income is where we want to be. That may mean a B to you or a C to you. So hopefully that gives you the clarity.
Middle income, slightly below middle income, and no violent crime.
No violent crime.
Because?
It ain't worth it.
Operator risk.
Yeah, operator risk. And I'm not going to manage your properties there. I have a team of 130 individuals, plus literally hundreds of folks that are on a contractor basis that help us manage these homes. And I care way more about health and safety. Yeah,
so just basically the TLDR there is the best teams will not put their people in harm's way for a violent crime, right? So you can find a well-priced, well-positioned C neighborhood, but if it has a lot of violent crime, then you're going to get more variable results because of, that part of it as well.
That's right.
So that being said, right now, really interesting things are happening in the rental property market. Two particularly interesting things. One is mortgage rates have dropped, right?
Guys, I think this is a very unique moment to either begin investing in rental properties or to add to your portfolio. And so I wanted to share why. It's a confluence of a couple of factors. The first is that we have seen some relief when it comes to our mortgage interest rates as rental property investors. So I put this slide together to show you that the average 30-year mortgage rate has dropped about 0.5% since June of this year. What that means, of course, is more positive cash flow for you if you're buying your homes today. Might be a refinance opportunity if you already own homes today as well. This is a great thing for rental property investors. And I want to kind of put it in context here. So I went back to June, which was the highest average mortgage interest rate for this year. And it across the country, it came in at about 6.9%. Now it's about 6.3%. As an investor, when you invest with a reputable vertically integrated provider like JWB, you're always going to be able to get lower interest rates because of their investor network. Ours happened to be, in June, our clients were getting around a 5.5% interest rate. Now, clients can get a sub 5% interest rate on a 30-year fixed rate mortgage. So many of you are not aware of this, but you can get sub 5% interest rates. That's huge. It's not just huge because of the positive cash flow. But when you drop your interest rate, now what you can do is you can put less money down on the property, because the way the math works is we need to make sure that these are positive cash flow investments. If your interest rate comes down, your monthly mortgage payment comes down. And if now that comes down and you are a little bit more cash flow positive, well, guess what? You can put less down and still remain cash flow positive. So ultimately, this is like a huge double win, because what happens is instead of having to put 30 or 35 or maybe 40% down in order to get into a growth market like Jacksonville, you can put 20% down. You can put 25% down. And this might save you $10,000 or $20,000 of cost that you don't need to put down now. So a huge win on the interest rate side, and one of the reasons why now is a really special time.
So more monthly cash flow, less capital up front for that monthly cash flow.
Yes.
Pretty good deal.
Big time.
What's the other thing, GC?
Well, so this is the other lesser known fact, is that right now, have you read articles about how sales are slow?
I've read articles.
We all have heard it, right? Sales are slower today than they were certainly a few years ago.
Yeah.
Builders have a lot of excess inventory, and builders don't like having excess inventory. So what is happening real time today is that builders are offering large cash incentives to investors today to be able to sell their homes. It's this unique moment where interest rates have started to come down. When interest rates come down, home sales will go up, right? We know that's going to happen, but it hasn't really happened yet because interest rates largely just started going down more recently. So we're at this unique moment where builders are still offering these large incentives that show up as cash to you. So the average incentive for one of our clients right now is about $15,000. I mean, first of all, incentives from builders to be able to, as a cash payment going to you, is like unheard of.
Like $15K in your pocket for investing in a rental property.
Exactly. That's what you get today. In June, it was still unheard of. Our clients were getting about $5,000 for these cash incentives, which was way more than any other time that we had seen in our last 20 years. But now it's about $15,000 because the pressure of sales is there for builders. And this is cash. Again, this isn't like a credit that shows up or drops your interest rate. Like $15,000 going to our clients right now to buy. So lower interest rates means less money out of pocket and more cash flow. And then you also receive these very substantial cash incentives. It's a unique moment that's not going to last, because what's going to happen is as interest rates go lower, you're going to see builders shave off those very high incentives as sales increase. So I wanted to bring this to light because this is a unique moment in time, and I think it's something that you guys can take advantage of.
Yeah, and just to wrap it up, we have that today, right? Like it's this idea of like there's higher positive cash flow right now. There's less money to put into it in order to get that higher positive cash flow, and you get kind of like peak incentive offering right now of builders putting money in your pocket in order to do stuff. Is a nice little triangle of like benefits that exist in this particular moment. I want to just say, if you want to talk to JWB about this, you can call them at 904-677-6777, text them at 904-293-0341, or put your own appointment in. Go to jwbrealestatecapital.com/FB for Fortune Builders. Roger Erlob is asking, what is the average square foot home price for JWB investments?
Our average price is somewhere around $225,000 to $250,000, which is really low if you're coming from somewhere like California or New York. And then on average, your homes are about 1,200, 1,300 square feet.
Got it. There you go. Carla Correa, who is, I think she said she was in St. Augustine. So she's like, I'm close to Jacksonville. Can you dive deeper into areas you're investing there specifically?
Yes, absolutely. And we'd be happy to go even more in depth, and I'll go right here for you, Carla. Just reach out, set up a time to speak with the team. We'll tell you specifically the neighborhoods we've been investing in for 20 years. But we invest in Arlington, the west side, north side, and south side of Jacksonville. These are neighborhoods that are all surrounding downtown Jacksonville. Because as Pablo mentioned early on, we're big believers in the revitalization of downtown Jacksonville, because we know that if you can own single family rental properties around the next great American downtown, you're going to receive higher home price appreciation and higher rent price appreciation. And your residents, everybody in Jacksonville, will see higher median incomes, which will lead to higher quality of life. So I love that you've been able to put this, this is great timing. These blue dots that you see on the screen are the 5,600 plus single family rental properties that JWB manages for clients just like you. And you can see they're all within 10 miles of downtown Jacksonville, which is a huge growth opportunity.
I'm glad that Carla asked that, because, we're talking about overall investing criterias. This is just standard for every single market. The idea of you want to find a market with the right home price to rent ratio that gives you positive cash flow. You want to have a place that's over $1 million in residents. You want to have a balanced economy. And you want to find these neighborhoods that are, that you can invest in workforce housing without violent crime. There's something that we get to talk about a lot on our show that this is actually a good segue to, that we weren't really, it's not part of the overall criteria because it's so unique, but it's the idea that Gregg and his team have figured out that when it comes to cities, right? Like the cities of the last 10 years that everybody wishes they would have invested in are what? They're Nashville, they're Austin, they're Charlotte, they're Tampa, right? Like these cities that people wish they would have put their money into 10, 15 years ago, and now are like, oh man, God, now they've gone up so much. How the price to rent ratio has gone out of balance, so it's
Right.
become a wealthy person's game. What is similar about all these cities is that their downtown became a thing. And a downtown becoming a thing, the way that the people talk about it, it goes from being an 8-hour downtown to a 16-hour downtown, meaning people go from just going down there to work, take some lunch with them, and then go home, to people work, live, and play in these downtowns. All that has happened in these cities. And we found that cities that go from 8-hour to 16-hour downtowns appreciate, on average, their home price appreciation on average beats the U.S. average by 89% once that happens. And we are finding that right now, Jacksonville is in that exact moment where that switch is turning on because of the numbers. GC, what are the numbers that people need to know about a downtown turning on?
89% more growth.
Yeah.
Substantiates that if you want to own single family rental properties and you want to see the biggest growth engine, look for the next great American downtown.
Yep.
The next thing to pay attention to is, how do you know what the next great American downtown looks like before it happens? Because you want to invest right before it happens, right? Well, what you need to look at is population growth inside that downtown. There is a critical mass of 10,000 residents living downtown. And every one of those success stories, Nashville, Austin, Denver, Tampa, they all cross this 10,000 residents threshold. And when that happens, growth starts to skyrocket. So knowing where your downtown is, or where you're thinking about investing, and how many residents are currently living downtown, how close is it to 10,000 is really critical. And then what we have found is that other successful examples like Nashville and Austin, it was about 7,300 to 7,600 residents living downtown was the optimal time to be able to invest in those markets, because you could still get positive cash flow, but within 5 to 10 years, their market downtown skylines had completely changed. Median incomes went way up, home prices went way up, and rent prices went way up. So that 7,300 to 7,600 residents living downtown is the optimal level. And that is.
And what's the punchline on the numbers for Jacksonville?
So we're at 7,600, right? We are.
Yeah.
And there's $5 billion of activity construction going on in downtown Jacksonville right now, of which JWB is a major player in one of the 3 major projects that are happening. There's dozens of projects though. So I wish we had more time today to really go into this. If anybody would like to learn more about this strategy, specifically, this is a specific JWB strategy that you don't find in other cash flow providers or turnkey rental property providers. It's about investing in a great market that is next to this catalyst known as the revitalization of downtown. If you'd like to learn more, please reach out to us. We talk a lot about it in this report. I think you're bringing the report up as well.
Report up, yeah.
We talk a lot about it in this report. If you want the numbers, the stats, if this is the first time you're hearing it and it just takes a little bit to sink in, download the report and then jump on the phone with my team, because this strategy is the biggest opportunity to catapult your return on investment in single-family rental properties without taking more risk.
Yeah.
That's the beautiful thing here. You can buy these assets that are cash flow positive and just ride the wave of the next great American downtown.
Yeah, and what Gregg means specifically is if you are investing in a downtown when it's 7,600 residents, these are very cash intensive projects that have a long horizon, have a lot more risk to them. But if you're investing in the single family homes that surround these projects, because many developers are developing down there and they're doing their thing, those single family homes are these underpriced assets. That's kind of like, yeah, I like to compare it to just like, you bought into a company when they were already doing well, but you knew that they had a bunch of really big stuff, right? Like buying Apple right after the iPod came out, but knowing the iPhone is coming and knowing that the iPad is coming and knowing all these different things are coming. It's like the ultimate insider real estate tip that most people haven't figured this out, because this last wave of downtowns is what proved it, right?
Yeah.
Like we just saw it happen for the first time, and Jacksonville is the city that happens to be up next to follow the exact breadcrumbs on the exact path, and it really happens very, very rarely.
It does.
Which is one of these big differentiators between these like less than 1 million, like inhabitants and all these kinds of things. Like this urban center thing is really a thing that's happening. Yeah, go ahead, G.
No, I was going to say it's unique what we have in Jacksonville. And when it happens, if anybody's lived in Tampa or Austin or Nashville, when it happens fast.
Yeah, Ariel's got some great next questions. How do college towns play into your downtown discussion? People living in a downtown, do students count renters versus owners? I think you got a good answer for this one.
Yeah, one of the 3 big projects that are happening in downtown Jacksonville, the 3 major catalysts, is the University of Florida is building a graduate campus downtown. They aim to have 10,000 students and faculty living downtown Jacksonville. This is, if you think about what the University of Texas means to downtown Austin, or any of these major universities that are housed in a downtown, like this is a major, major flywheel generator type of effect for bringing not just the numbers of people living downtown, the type of people we want living downtown, because they attract jobs, they attract higher incomes. So much exciting is happening in downtown Jacksonville. Please reach out to us if you have more questions about that. To answer your questions directly, Ariel, how do college towns play into your downtown discussion? Well, we have a college town specifically in downtown Jacksonville. And people living downtown, do students count? Yeah, everybody counts. Renters versus owners, there's a whole lot of renters. That would be the population in downtown Jacksonville right now would be a whole lot of renters.
Yeah,
there you go.
The key is density, right?
Yes.
Like the key is density in order to do this. I live this in Miami, right? Miami is another city whose downtown went from being an 8-hour downtown to a 24-hour downtown, right? Like, and what you're looking for is density, right? Because once people are living there, people are making the calculus of, oh, okay, I can move to this city because I can live, work, play in an area and displace my costs of like car and other things that you have to pay for because you have all these amenities around you. And the amenities come when there's density, right? So that like 10,000 resident rule happens because once there's 10,000 people there, you want this like mixed use feeling of people living above the businesses that they frequent, and you need these anchor tenants that do it, right? So like once you have the 10,000 people there, these anchor tenants decide to move in. They are a big part of funding these projects. It attracts more people. And when you have an institution, this is what we didn't have in Miami that we couldn't pay for, right? Like Miami had all the money in the world, but they couldn't pay for this. The fact that University of Florida is bringing a graduate campus, not just a graduate campus, but a graduate campus for healthcare tech and fintech that's powered by the biggest AI supercomputer that is publicly owned in the United States, that's at the University of Florida, is part of the reason why Jacksonville has become one of it's the #1 corporate relocation city destination in America. It's the #2 rated Wall Street Journal job market, right? So like these, and the reason why these companies like this is because they need A, to leverage the universities for hiring folks. They need B, to leverage the universities for like developing new products and stuff like that. So an institution coming to downtown is a really, really big thing. And it's very different than being a college town, right? Like
Yes.
at the end of the day, a college town is a college town. A city that has a world-class institution developing talent and giving it out, right? That's when you're thinking about like the Bostons
Yeah.
and the Berkeleys,
There you
right?
go.
And I was about to say another one that is like New York, right? NYU, Columbia,
Right.
right? Like those are the types of that's a much more apt comparable
Well said.
than a college town, right? Because you get the whole balance of the whole ecosystem.
Well said.
I'm passionate about it.
We both are. And appreciate the questions that kind of let us talk about a little bit more downtown Jacksonville things of that nature. Guys, I know we're over here. Thank you all for being here. If you have additional questions and we aren't able to get to them, please reach out to our team. That's why we're here. There is no cost to jump on the phone with us. It's included in your tuition as part of being a part of the Passive Income Club and Fortune Builders. And we're here to help. You can call us 904-677-6777. If you want to just text us, ask us a question or set up a phone appointment, you can text. And there's a real human on the other side. One of my teammates right over here is going to respond to 904-293-0341 or set up your own appointment at jwbrealestatecapital.com/FB.
And last but not least, Greg and I host every Tuesday at 12:30. We host what we call the Not Your Average Investor Show. We host it live here on Zoom. We have hundreds of people. Many of them are Fortune Builders folks
Yes.
that join us on a weekly basis to just talk about investing, answer questions, talk about like what is going on in the economy and different things and teach different topics. Very interactional. You can join us on Tuesdays. We'd love to have you, right? As a very vibrant community like Fortune Builders, where people make connections and become lifelong friends. We have a yearly event, very, very similar. So you can join us on Tuesdays, or if you just like podcasts or YouTube, if you just search Not Your Average Investor Show on any of your platforms where you like content, you will get a whole bunch of me and Greg in your ear, giving you our best advice and introducing you to our favorite people.
There you go.
So that being said, hope to see you on the next one on Tuesday. Hope you like this was really valuable to you. We want to commend you for taking an hour of your day to get educated. And we always leave with one little piece of advice. What is it, GC?
Don't be average.
See y'all.
See ya.